when you look at that cost increase in recent years and compare it to the rise in value of gold, and more importantly for miners, the increase in margins that results due to the price increase in gold, it's like night and day. So yes, costs have gone up, but they've gone up nothing like the value of the extracted ore. And so if you look at the bottom line, if you look at the actual cash generation of their operations today, those margins are as big as they've been in decades in some cases.
The gold price left gold mining stocks for dead for yet another year. Gold surged 27% in 2024, while gold stocks were up a mere 10%. In currencies other than the US dollar, the divergence is even more stark. But how long can such a divergence continue? Gold stocks are supposed to rise an order of magnitude more than the underlying metal they mine, not less. I'm joined today by Southbank Investment Research's Investment Director, John Butler. John wasn't just an award-winning investment banker, but was also part of the gold money team as well. He also literally wrote the book on gold's resurgent role in our monetary system. That means John is one of those rare exceptions that has straddled the mainstream financial world, as well as the more contrarian and controversial world of gold bugs. That makes him the perfect person to ask about gold mining stocks. The sort of asset allocation and investment strategy decision of whether or not to hold gold stocks is exactly what John did in the investment banking world. These days, he helps investors like you make the same decisions for themselves at the Fleet Street Letter. John, in this video, we're going to talk about a series of 5 charts which explain why gold stocks are likely to outperform in 2025 and beyond. But first, let's go back through the last few years of incredibly frustrating underperformance first. What went so wrong for gold stocks, I would say since 2021 or 2022? I don't know how far back you would go.
Well, if you're looking at that time frame, there were some specific setbacks for the precious metals mining sector, or specifically gold, if you prefer. And some of that was simply industrial disruptions that affected everything as a result of COVID and lockdowns. And the mining sector, of course, was particularly affected by that because of the fact that if you're working in a mine, you're working in rather close proximity with other people, and it's extremely difficult to really do that and observe some of the regulations that were being imposed at the time. So that was disruptive. It led to some cost spikes in compliance costs and whatnot. Presumably that was a one-off. So I think we're past that now. But the reality is that the mining industry in general has traded at a historically low valuation level in recent years. It's not particularly sexy. People don't see a lot of growth potential. So mining in general has been treated that way. You can look at all your big mining and materials firms, your global leaders in iron ore and copper like BHP or Rio or Glencore. So this is not strictly a gold miner's story. And in fact, many big institutional investors, they don't really specialize in gold miners. They kind of lump them in with everything else. And so that may also help to explain why valuations have been lingering around these depressed levels.
If we focus on the cost argument there, have we seen measures of cost for gold miners per ounce of gold that they produce rise in the way that you would expect based on the pandemic, based on the inflation, based on the supply chain chaos, based on whatever else has gone wrong? Has that data actually come out?
Well, what you find is that, of course, look, inflation is up everywhere. We know that, right? And that does impact labor costs. It does also indirectly impact the cost of capital. But when you look at that cost increase in recent years and compare it to the rise in value of gold, and more importantly for miners, the increase in margins that results due to the price increase in gold, it's like night and day. So yes, costs have gone up, but they've gone up nothing like the value of the extracted ore. And so if you look at the bottom line, if you look at the actual cash generation of their operations today, that those margins are as big as they've been in decades in some cases. It depends on the mine. Some mines are more expensive to operate than others, but for the industry as a whole, we're literally talking a multi-decade high.
Yeah, you've given away everything, John. That's our 5 charts. There's nothing left to talk about. We've actually got to have a look at the chart. You said something at the end there that it differs based on different mines and different companies, which is something that people should always keep in mind. But let's go through these charts, which are industry-wide. There's actually a couple of different ways that we've measured gold stocks as a group for these charts. And let's see if they help people decide whether or not they want to own gold stocks for this year and perhaps for the foreseeable future beyond that. So the first chart shows the divergence between the gold price and gold stocks. So take us through this chart, John.
Well, here you see it, right? It's pretty black and white. Gold's been on a tear for years now, and the miners have really limped along. Now, that said, if you look at very recent past, just the last couple of months, that picture may be changing, but we're talking early days here. So if anything, it's encouraging from a trader's point of view, from a speculator's point of view. You would look at that divergence maybe beginning to close and think, aha, this is a great opportunity to move from one into the other, or simply to get long the one that's been lagging. However, the bigger picture, as you say, is that miners are very, very depressed here vis-a-vis the price of gold.
So I'll quickly take a stab at trying to explain the specifics in this chart, which shows a ratio between gold stocks measured by the GDX ETF and the GDXJ ETF. The top one being the larger cap, bigger gold miners, and the GDXJ being the juniors. That's what the J stands for. The ratio between the two showing that when the ratio is falling, the value of gold relative to stocks is rising, and when the ratio is rising, the value of stocks relative to gold. So the point being that they're extremely undervalued right now, especially the GDX, also the GDXJ to a lesser extent. And like you say, there's been a bit of a turnaround since I think this chart came out very recently. But it's basically showing what I said in the introduction, that the outperformance has been in the gold price, not so much in the gold stocks. Now, if we were to show this chart in a different way, where the gold price has been going up faster than gold stocks, it would create what investors sometimes call alligator claws, jaws, not claws. The alligator's jaws. The alligator's jaws have opened, and at some point they're going to snap shut. And the question is always how? Is the gold price going to come back down, or are the gold stocks going to catch up? Which of the two are you expecting, John?
Well, I think gold is going to remain in an uptrend. Now, that uptrend may not be as pronounced as what we saw over the last year or so. I mean, that was really quite a move, as we saw in the first chart. And so you do need to accept that was, we have had this exceptional period. But then again, gold's been rising for all the right reasons. We went through a big wave of inflation, and even though inflation's come down, it's still positive. And indeed, government policies suggest that it might be going right back up again. We see excessive spending just about everywhere, and we see other things that are inflationary just about everywhere. So that's a good reason. The other reason, of course, is that there's just a lot of risk in the world. I mean, the world, I think most people would agree, the world is a more dangerous place today than it's been in decades. And that's, that's not nice to talk about, but, we have to, as investors, we have to look at the world as it is. And gold's a classic hedge against everything. And then the other thing to point out, of course, is that there have been some specific actions taken, in particular following the outbreak of the Ukraine war, which call into question the very structure of the international monetary regime, the role of reserves, and the role of government bonds and other official assets as reserves. Because if those can be frozen or outright confiscated, as has been the case now, that makes governments and central banks maybe wonder whether they shouldn't accumulate the pace of their gold reserve, however they go about building it up. Will they jump right out into the market and buy more gold? Will they implement a strategic plan to simply acquire it regularly as a larger portion of whatever reserve accumulation is taking place? Every country is going to make a different decision. But the thing is this. You do not need to have been the target of sanctions or asset seizures to take action, because everyone sees now that the danger is there. If you run afoul of the powers that be, led perhaps by the United States, of course, if you run afoul of them in future for whatever reason, your official assets, government bonds you hold, U.S. Treasuries say, could be frozen. Maybe your coupons won't get paid, and so on. That doesn't happen with gold. So gold's been going up for all the right reasons, which makes me believe that it's not going down again. We might get into a bit of a range trade for a while as a bit of profit taking sets in. You lose a bit of momentum. That could well take place. But I don't think we're going to see lower prices, materially lower prices from here. And that's important for miners' valuations. Because if investors think that gold is simply spiking higher and it's going right back down again, why give a mine with a 10 or 20 year or perhaps even longer life a higher valuation? But if you think we're going to retain this level at least, if not go higher, then mining stocks, gold mining stocks, are an absolute steal here.
We're going off on a bit of a tangent here, but I like it because I want to ask you whether that geopolitical risk matters for gold miners in the sense that their projects are more likely to be approved by governments around the world who are keen to secure domestic gold supplies over a longer period of time.
Well, look, it's a net benefit. If you have a hole in the ground which is able to pull out something which is suddenly not only more valuable in the marketplace but is of greater strategic importance to your government, then yes, you're more likely to get this favorable regulatory tailwind. We're well aware that we live in a world today that, for good reasons, is very sensitive to anything that might cause some degree of environmental damage. Now, I don't think that's going to change, although one could argue, believe it or not, that when it comes to mining, gold mining tends to be less environmentally destructive than many other forms of mining, because gold mining, a far smaller proportion of it is open pit than is the case with many other materials and metals. And so gold miners should kind of get an easier pass anyway. But yes, other factors equal, having a regulatory environment that is supportive, having a government that is supported of what you're doing is a boon.
All right, let's move on to the second gold chart. This one shows that the stocks in the GDX, yes, it is the GDX, are extremely cheap relative to their free cash flow. So let's start by defining terms here, I suppose. What's free cash flow for gold miners?
Well, free cash flow, and this can apply to any company, but basically what it means is how much cash are you generating from operations that does not need to be reinvested in operations in order to counter depreciation of your assets. In other words, if you're going to remain a going concern indefinitely, some of the cash you generate has to be plowed back into the company, or your assets will depreciate and eventually you'll have no assets. Okay, that's what free cash flow is. And so it's an extremely important metric because it's not really manipulable the way official earnings might be, because there's all kinds of accounting hocus pocus that might occur between the cash you generate and the profit that you generate. Free cash flow is a relatively non-manipulable item. And so you look at that and it really smacks you in the face that you're looking at extremely cash generative companies that, even by reinvesting as required to maintain at least their current level of production, they're a steal again here if you look at it in ratio terms. And so as an investor, I mean, just scratch out the line that says this is a gold miner and just say this is an industrial company. What do you think? Almost any investment analyst would say this company is a buy.
And the point in this chart is that when the blue ratio, is extremely low, it tends to trigger a sudden increase in the stock price of gold miners. Historically speaking, that's been true, is basically saying that when miners are cheap, based on how much they're earning in terms of cash, they tend to rally subsequently. And we're in an extreme level of cheapness right now, which implies extreme undervaluation. That measure of free cash flow, it's unusually difficult to perform that analysis for miners, right? Because they have this large asset that depreciates over such long periods of time, and trying to measure how much cash they should be spending on trying to find another mine in order to have their next large depreciating asset or not. It's a pretty difficult calculation, right? Surely that makes this less exact than for other industries.
Oh, for sure. That said, I mean, the ability to determine the potential life of a mine or to have some sense of it is way better today than it used to be, because nowadays you have all these geophysical techniques to analyze what's going on underground, to try to get a sense of what it is you're dealing with as the mine continues to develop, as it continues to expand, as ore continues to come out of the ground. I'm not talking about junior miners here. I'm not talking about pure exploration. But when it comes to actual operating mines, in fact, things are much more certain now than they were decades ago, for example.
Why does this occur? Why are gold stocks over and undervalued relative to their free cash flow by such dramatic amounts, allowing the GDX gold ETF to rally so much and to fall so much in some cases? Is this normal market behavior? Is it unusually large for the gold sector? What's really the explanation for this?
Well, there's probably more than one explanation, but one simple one is what I mentioned earlier. The fact is that gold miners are not, there's not a whole lot of institutional interest in gold miners. It's as if no one pays attention until there's a really good reason to pay attention, and then you reassess the industry, and perhaps you do decide to have a strategic allocation to gold miners specifically, rather than just lumping them in with the metals and manufacturing sector from a sort of big picture top-down macro point of view. So some of it may just be that, the effect of investor sentiment, losing interest over time in what is a relatively narrow, specialized area, and then looking at charts such as these and finally thinking, my God, we should actually get seriously active here. So that may be part of it. But look, any sector, however small, market dynamics being what they are, you're always going to get swings like this. You're always going to get things that get overvalued, things that get undervalued. It's just the nature of markets to overshoot. And you could apply that almost anywhere. It's just that we do happen to see a relatively extreme example of that at present with respect to precious metals miners.
Another brief tangent. You've said a few times now that the investment sector tends to lump gold miners in with other commodity producers. What's your argument for why they shouldn't? Why should gold stocks be different?
Well, that's because gold's fundamentally different than the other metals and materials, because the fact is that gold isn't really consumed. I mean, fine, it might end up in jewelry, but jewelry can find its way back into the market. I mean, that is not true of other industrial metals and materials that are effectively consumed beyond economic recycling reuse. I mean, some are easily recyclable, but a lot of them are not. And so what that means is that gold is fundamentally different, which is perhaps the best explanation for why gold emerged as the preeminent global money, because of the stock to flow ratio being as high as it is. I mean, the current the current gold miners out there working flat out to pull as much ore out of the ground as they can might be able to add maybe 1.5% to the above ground gold stock in a given year. And that's really if conditions are right, if they're going flat out and so on and so forth. And so it is fundamentally different. You're not going to get the boom bust in terms of production, in terms of demand and supply that you get in iron ore, that you get in copper. And so it's understandable that your Glencores, your Rios, your BHPs are going to go through these big cyclical swings along with the normal business cycle. Gold miners shouldn't behave in the same way. That doesn't mean there shouldn't be any cyclicality at all, but there should be substantially less. And yet you find at times that they just follow along almost in lockstep. And I think it's almost laziness, perhaps, on the part of investors to sort of lump all miners together. Precious metals miners should be treated fundamentally differently, in my opinion.
You mentioned the stock to flow ratio there. That's the idea that people buy gold in order to hold it, to own it. They don't buy it in order to consume it, to use it up in any way. So the amount of gold that is held as a stock is very high relative to the amounts actually moving about. Ironically enough, the part of Japan that I occasionally live in, that my wife is from, is the part that produces the gold leaf that actually is consumed on all sorts of ice creams and all sorts of weird other ways. And I often buy gifts for friends and family to consume gold. I don't know if I've ever given you any, John. Maybe I should, and it might change your views on whether or not to consume gold. Let's move on to the third chart here. We've got gold stocks, again, valued at extreme lows, this time relative to the value of their assets, which I presume largely means gold in the ground, gold that they haven't actually mined yet or that they're in the process of producing. So, John, can you take us through this chart?
Well, I mean, look, as you mentioned earlier, it may be challenging at times to really assess the value of a mine. But there are ways to do it. And I do believe, as I said earlier, that those methods for determining just how much ore is down there, how much time and how much money it will take to get it out of the ground, those are considerably more exact estimates using modern technology than they were some decades ago. And so for the gap to be this large, it does look like a tremendous opportunity. People are basically discounting the value of those assets. They're basically saying, actually, gee, we're not terribly confident those assets are, what you claim they are. And so, look, there should be skepticism in any industry. There should be skepticism in any valuation methodology. Due diligence should be done by all investors all the time, regardless of what the object is. But this is a huge gap, especially when you do take into account what I said about improved technologies for realistically estimating what is going on down in the earth. And so, unless you think that there's outright fraud going on, which has happened. I mean, I don't know if you've seen that movie. What is it called? Just Gold, I think it is, starring Matthew McConaughey. So, a fairly big budget movie about the famous Bray X gold fraud of some, oh gosh, what is it now, 20 years ago or something like that, that resulted in a huge losses and even the tragic suicide, I believe, of one of the gentlemen involved, murder or suicide. I'm not sure they're sure which it was. In any event, that sort of thing is extremely rare. So if you assume that there's not outright fraud going on, and you assume that the ways in which we estimate what's available in the ground are pretty solid, then this looks like a huge opportunity here.
The easiest way to think about this chart is if you are the CEO of an extremely large mining company and you're trying to buy a gold mine by acquiring the shares of a gold miner, a smaller gold miner, you would be getting that miner on the cheap relative to what you expect to be in the mine. So this suggests that there is a lot of takeover activity that's likely to come in the next few years if there is some interest generated in the sector, which is great news for investors, obviously. Chart number 4 is something we spoke about earlier. It's the cost base. It shows part of the cost base. It's a favorite indicator for gold stock investors. It's the gold to oil price ratio. So what's the gold to oil price ratio and what is it showing us at the moment?
Well, the gold price ratio can be used for a variety of things, but let's get specific about what it means for the cost of operating a mine. The fact is, mining is extremely energy intensive. Oil is the global energy benchmark. And so if the value of what you're using that energy for, that is to get gold out of the ground in this case, is very, very high relative to the input cost of that energy, well, that implies that your production margins should be unusually high, as indeed we've already discussed. And so this here you see it in one chart, the cost of input and the value of your output. It's big, right? It's a big margin. And so if we're going to remain in this sort of environment, relatively high gold price, relatively low oil price, then margins should remain elevated for a sustained period of time. Hence why it's potentially quite good news, actually, that Trump and possibly other leaders under the direct or indirect influence of Trump might actually encourage some renewed investment in traditional fossil energy capacity, something that has been demonized in much of the world over the past decade or two. If that kind of changes and people, adopt the drill, baby, drill mantra, then oil prices are perhaps going to remain fairly low for a sustained period of time. And yet if gold can retain these gains, then the margin between input and output will remain high for a sustained period of time, supporting significantly higher valuations for the gold miners.
I just want to quickly point out that the spike that we saw in the 2020 year on that chart was when the oil price completely crashed because of COVID. So we kind of can disregard that and conclude that actually In terms of oil, at least, mining for gold is extremely cheap right now, which should, over the next few quarters, show up again in the free cash flow of the gold mining sector. Our fifth chart shows gold stocks relative to the value of the S&P 500. So why would you want to create a chart like this, John?
Well, because this one shows you so clearly how either the S&P 500 is way too expensive here, or gold miners are way too cheap, or it could be some combination of both. I mean, I'm amongst those who are skeptical that some of these extremely lofty tech valuations are really going to be sustained longer term. That said, you can say, okay, no, fine, maybe they're okay where they are. But then you look at the gold valuations and you think, my God, I know this is such a deep value industry. You know, you look at it, you look at the gap and you think, my God, maybe this industry is even distressed. But then you look at the free cash flow figures. Something doesn't add up here. It's not a distressed industry at all, yet it's nearly trading at a distressed valuation. So anyway, it's night and day, right? It's really, really night and day. The concentration of the S&P's valuation, as we know, is in big tech. Less than 20 firms in the S&P account for some 75% of that index's valuation. That's a historic high. And it's also, if you ask me, a historic warning that something is wrong with the valuations of the most expensive companies in the world today. But again, you don't have to take my word for that. Don't even just look at the gold miners trading in comparable terms as distressed stocks, yet with outrageously high free cash flow, and that speaks for itself.
The reason I mentioned earlier that you're an expert in the asset allocation and the strategy side of things is because investors got to put their money somewhere, right? And so that's why we've got ratios here. We've got ratios showing what is unusually expensive relative to gold stocks, what is unusually cheap relative to gold stocks, so that people can make decisions between different investment opportunities for where to place their money. If you put all this together, you'll conclude that gold stocks are undervalued, underowned, unloved, and underappreciated. And nothing on the stock market has the capacity to soar as much as its most unpopular asset. We hope this video has helped you make an informed decision about whether you want to own gold stocks or not in the next few years. John, thanks for joining us, and to everyone else at home, thanks for watching.